So let's talk about how shareholders set up a business. What are you going to learn in this? Well, you're going to become familiar with the basics of setting up a business. You're going to understand how shareholders put money into a business. You're going to know what makes a shareholder's contribution grow. And you're going to learn how to calculate a shareholder's level of ownership in a business. So today we're going to be starting a business, and it's called the Magic Powder Company. Let's get into it. Let's just start this Magic Powder Company. And as I say, people will line up every day for our magic powder. And every day they're going to come back for more. Why? Because we have such a great idea. And our idea is to make magic powder. And magic powder is exactly that. It's magic. So, how do we set up a business? Well, we've got to decide on a name, an address. We've got to designate the shareholders, the directors, the promoters, the people that are starting the company. Decide on which form of company. Is it a sole proprietorship, meaning one person? Is it a partnership? Or for most of the things that we're looking at, it's going to be a corporation. So we're going to set up a corporation. We're going to draft the bylaws and assign who's authorized to bind the company, to sign checks. We're going to register with the government and get a tax ID. We're going to have our first shareholder meeting. And in that first meeting, we're going to appoint the officers and adopt the bylaws. And then we're going to issue share certificates to new shareholders after they deposit cash in the business bank account. Now you can see an example of a shareholder certificate, and I have some other ones around here, but I can't find it. I have some old ones, which I'll show you later. So who are our cast of characters in this journey of setting up our company? Well, we need entrepreneurs and we need a banker. We need a machine salesperson. We need a raw materials salesperson. We need an employee. We need a landlord, and we need a customer. Those are the cast of characters. Those people we're going to be talking about as we go through this journey. So first we need two entrepreneurs who have money. They got to have cash. So now, of course, not every entrepreneur is going to have money. But because this is ridiculously simple, we're going to start with the simple assumption that they have a little bit of money. So, and then we need a banker. We need one person who can safeguard that money. And there is the banker in the middle. So let's talk about the next thing is we have to open up a business bank account and move personal money into that account. We're going to talk a little bit about paid up capital, equity share, those types of things. But let's talk about first, we have to inject paid up capital into the business. This is also called equity. Now, entrepreneurs, deposit your cash in the Magic Powder Company bank business account. Your banker, therefore, is going to receive 100, right? So imagine we have our two entrepreneurs. They're going to say, go to the bank, put in their 50-50, and it's going to get to 100. So let's now when you see in the bottom right, it says education. I've tagged that so that you know if you see that sign, we're talking about the glossary. So here, we're going to talk about the first item for lesson 2. You can see it right here. And that is paid up capital. And so what you're going to see on the screen should match almost exactly what I have here. Occasionally I get a little out of sync. But the purpose for me is that I want to give you everything you need on here so that you can remember it well. So money that investors paid into a business is considered permanent capital. And in exchange for this money, the company issues share certificates as evidence of the investor's ownership. Sometimes this is referred to as equity or equity investment. Now, paid up capital is one component of shareholders' equity, right? Because, we're going to start the company with paid up capital, but there's one other component. So let's just talk about equity for a moment. So again, you go down to the next thing and you're going to see equity on the sheet. So let's talk about equity. Equity is a bigger grouping, and it's a combination of money that investors or shareholders contributed to the business. We've just seen that. That's paid up capital. And then it's the cumulative earnings retained in the company. And what does that mean? The objective of a company is to make a lot of money, pay out some dividends to the investors, but also keep that money in the company so the company can continue to grow. The money that's kept in the company is retained earnings. Now, more precisely, we call this shareholders' equity, but at least you get the idea. All right, so let's talk about share. What do we mean when we say share? Well, stockholders are also called shareholders, as owners of a company have a claim to a portion of the company's equity. Now, to determine that portion, divide the number of shares owned by the total number of shares outstanding. So if you own 1 share out of 2 shares issued, like we've just seen, then you own 50% of the company. Now, if there were 3 shares, and let's say there's 3 shareholders, then each would own 33% of the shares outstanding. And that's the concept of shares. So let's talk about the transactions. First, the business is formed, the bank account is open, and the entrepreneurs each pay $50 into the company, into the bank account. So that's 2 shares that they're issued. And we're going to create the balance sheet. But before we do that, I want to ask you, when the entrepreneurs put their money into the bank and they get their share certificates, who issues the share certificate? Well, it's not the banker. Banker is just taking care of money. It's the company that you've just formed that will have a record to say, we have a record that you paid that money into the bank, and as a result, you have ownership of X amount, and here's your share. So it's the company that issues the share certificate. So what you've learned, well, set up a business name. We got to set up a business name, a type of business, bylaws, government approvals, shareholders meetings. Shareholders inject paid up capital, also called equity, and in return, they receive shares. Equity is paid up capital plus the cumulative profit that is retained in the company. And finally, shareholders' ownership is based upon the number of shares owned divided by the total number of shares.
Personally, I was able to apply everything that was happening in the boot camp and how what you guys were explaining and apply it to my business that I work for, right? So I work in the printing industry, and I seen that through COVID, we increased our inventory. And now I can look at it like, okay, our inventory conversion days went down. You know what I mean? They're increasing their prices. Well, okay, well, this is why. Supply chains is going crazy. And so that gave me a better perspective because I was able to make a one-to-one correlation to everything I was learning.